Okay, so how often do you talk to clients who are like, hey, I got an idea. Have you heard of this stock? You know, and they're like, hey, I got a great dividend stock I want to share with you. What do you think of it? They ask your idea. What are they really trying to get at when they're asking you a question about a dividend stock?
I think they're trying to validate, like, am I on the right path here to like what you guys look at? I think is what's driving a lot of it.
Yeah, I think it's the same
curiosity.
When I get a question from a client about a specific stock or somebody else, it's that, how would you rate it, or what would you do with it? Am I in the right game? You know, am I looking at the things the right way?
Well, no, but a lot of times they'll look at the yield and they'll come and they'll be all excited. What do you think of this one?
Would never buy it.
Let me not say that because I don't want to hurt your feelings. But sometimes people look for one thing and they'll often say, well, what else do you look at? So,
well, it's funny, like before we get into the actual topic we're going to talk about, when somebody asks you that question and you're like, ooh, this is bad. What do you say?
I know. Well,
depends on who it is. If it's a buddy.
Yeah, say it's a buddy. Right. Let's go both extremes. Somebody you know really well and somebody you're like, man, what do I do?
The tone and the verbiage will change, but really what I'm asking is, why did you ask about this one? And typically it's to Nikki's point. It's got a big old yield. You know, it's paying a lot of income percentage wise. Is traditionally why they're even bringing this one up.
Not to quit their day job. Glad I can be here for you.
Yeah.
Well, it's the shiny billboard.
I'm glad you're my client.
I'm glad you're my client. Sorry, Cal.
No, you're good. No, I was just saying it's the shiny billboard, right?
Yeah.
It's the Vegas lights. Like that's what they're grabbing. Whether that's they're scrolling or whatever it is, or their neighbor or their buddy said, I got a 20% return on this.
A client that I brought on a couple of, probably a year or two ago, he works for a great company and his company pays a dividend. But then he also is in kind of this position where he knows some of the other suppliers that they're working contracts with and things like that. And he's like, hey, what do you think about this company? And I'm like, it's kind of getting a little insider knowledge and stuff. But most of the time, you know, it's more, they're really small, more growth oriented. They're not really paying a dividend, or if they are, it's pretty small. But, you know, he's in the know of like, hey, there's some things coming down the pipeline where this could be a potentially good company.
All right, so let's jump in. The actual show we're going to be talking about today is 7 metrics that we're going to be checking before buying a dividend. Now, we're just giving some insights into some of the things that we look at.
But a lot of these things I bet are in that dividend starter kit.
I bet you they are. How could they get that?
Do you know? If not, subscribe, go get it, ask for it.
Yep. Actually had a couple people this week ask for it.
Did you?
Yeah.
Awesome.
Nice. Yeah.
So that's funny. That's a shameless plug. All right, so let's talk about metric number 1, which we're going to call dividend payout ratio. So what the heck is payout ratio?
What it is how much money that the company is actually paying out to pay that dividend. So it typically comes in kind of a percentage ratio. You want to try to keep that as low as possible because you don't want to see a company paying out 100, sometimes 150, 200%,
300, 400%. Now, wait, what would happen? Now, if you have a company and it's a great company paying a dividend for a long time, and they happen to, you look at that metric and, you know, some of our clients are like, did you look at so-and-so's payout ratio? It's 187%. Why are they in our portfolio? Why would we do that?
Crickets? Wow. Crickets. No, a lot of times there's some mergers, acquisition, there's some resettling of the books. Debt. They're paying down debt. So they're really, you know,
or buying back their own stock.
Right.
I mean, there could be so many things that take place that could inadvertently or actually on purpose make their stock look really bad, make their debt to ratio good, but looks bad now, but next year look great.
Correct.
Right.
So they're with some of these metrics that we're going to talk about, you have to understand, you can't just look at that and go, it's always that way.
Right. That's just like a snapshot. That's like a seasonal situation. Now, it's a concern if it's 5 years running of, you know, north 100% payout ratio, then we got some alarm bells going off.
Yes.
Well, on those
historical would be good. Actually, if you could look up the historical payout ratio, which I don't know if I've ever seen that. We'll have to create that.
Yeah.
Oh boy.
Historical payout ratio going back like 5 years, that'd be really fascinating.
It would be a great metric to see.
Well, and you know, the one thing I always think about with this one is at home, if you're spending 90% of what you make and then you have something go wrong on your house, you have a health condition, you're in trouble. Well, what if you're investing in a company? Do you want them spending north of 90% of what they takes to run their business on and not be able to pay your dividend? Is where I'm going with that. Does that make any sense? Help me here.
It does.
Yeah.
But I will
on a
say
normal year,
the
though.
asterisk to that
On a normal year
is what you fill out in your taxes sometimes isn't real life. Because I know a lot of people that show they make no money and they live in a gigantic home, drive beautiful cars, and you're like, yeah, I paid no tax last year. Love the way I can do my taxes. And you're like, so, and companies do the same thing.
Yeah, company. It's like
where
as soon
you
as
can
you think
play
you
the
got it figured
game
out. Yeah.
and you can make it look like you're not making a whole lot of money. Some of the companies make so much, it's very difficult to do that. But that's where you can see these payout ratios get flipped because they take advantage of something where a code was just, or a tax law change was passed or something, some law, and they're like, ooh, we're going to strike. You know, like the pandemic hit, and all of a sudden, companies did brilliant moves and they flipped their books upside down. They were able to like make some bad moves because COVID hit, and they're like, well, now is the time, perfect opportunity. And you saw all the ratios, everything go out of whack. Stock prices went down, dividends went up, dividend payout, buybacks, cash, free cash from the government, all crazy. And what did it end up doing? Most of those stock companies exploded. But the tax year looked horrible.
Yeah.
So good comment. All right, next one. 5-year dividend growth rate.
Oh, one of my favorites. Yeah. Honestly. It's, taking a look at, all right, how much is this company? Yes, they're paying a dividend, but over the course of those 5 years, how much are they increasing it? And that's really a strong metric for dividend payers, is you want to not only see them paying consistently, but increasing what they're paying each year.
And don't even look at just 5. Go to 10, go to 15, go to 20, like go as far back as you can. And this, if I can take a second or a minute and rant on my frustration of the Schwab dividend tool, I'm going to do it right here. When you have a company that has a history of paying a dividend for 50 years, and the way the companies declare their dividends, they declare them typically in 4 quarters. So they put the next 4 quarters. And Schwab dividend tool has been very, I think, pathetic in how it was developed in the standpoint, if a company has said they're going to pay for the next 4 quarters, and this is what I believe to be true in how they redeveloped it. I don't know why they did this. I can't tell you for certain, but it looks like this is what it's doing. If all the stocks in our portfolio are on their own fiscal year, they all don't match up perfectly. And you have one company that has paid 3 dividends, has one more, they haven't declared their next dividend. So for the projection, Schwab's not showing any dividend payment because there's only one more declared. So when a client goes to look at their historical or their projected dividends, they're all looking like they're paying less because they're not paying attention, or, I mean, they're not doing anything wrong. We can argue, but they're not necessarily making it look the way it probably will look in reality. So I see both sides of that.
For dividend investors, it's creating some fear.
It's misrepresentation.
Right.
Yeah. Now they're going to argue it's not. They haven't declared it. What if they don't pay?
Yeah.
Sure. You're looking at a company that hasn't missed a payment in 400 or like 100 quarters
since 1882.
Years. Yeah.
Right.
Like, and you're going to say, well, they're not going to pay next quarter, or you're going to make it look like they're not going to pay. Like I understand not showing a pay raise, or put an asterisk.
Right.
Like
it already says estimated annual dividend income.
Right.
So it's like, you have to understand that is an estimate. It is subject to change.
I just don't like
the way consistency is here.
It's made it look really bad.
Well, here's what I do love, and this came up yesterday on Simplicity. It's our planning tool, and I'm sitting with a client who is very fearful yesterday. And the fact that you can look at the estimated yield as we lay it out for folks in the Simplicity, and you go and it's within $12 of what you said for both of their accounts, that's pretty cool. So I just wanted to chime in on the predictability of the dividend. Now, we weren't using the Schwab tool. We were using the Simplicity. But
so what you're saying is Simplicity got it right?
Simplicity got it right. But we're coming on the end of the year. So
I see what you're saying.
I'm doing a lot of my year ends, and we said what it was supposed to be. And you went in, and I'm not kidding, both of the accounts were within $20 on the annual number. And it was really, really cool. So that certain things were creating fear for this particular client. And that just brought him down.
Power of Simplicity. All right, let's go through some of these quick. Revenue growth.
Self-explanatory there.
Yeah.
You want to see the revenue
This is
growing.
top line.
Yes.
Revenue growth, top line.
Exactly.
What's the company making gross before anything?
And that dividend, people think these companies don't grow? How are companies paying dividends for 150 years if they're not making money and growing?
Yeah.
It's just the way you're looking at it.
Well,
Sorry, that's my pet peeve. You've
What
got
irritates
one?
me about, when
I'm
you
like,
look
come
at
on, guys.
the top 100, the NASDAQ 100, there's probably not a company in that 600 mix that has lost money in the last 20 years. And yet, how many years in the last 20 years has their stock value gone down? How does the stock value lose money when the company is making it? Isn't that weird?
It's fascinating because it's all about what the future value of
It's
that
fear.
company. It is.
It's
strictly
people just
it's
getting
on
ticked
purpose.
off thinking it's going to go down. And yet the company's profitable.
Yep.
Well, and it's what Cal said earlier. It's the scrolling. It's the wanting to create that. I hate to be negative because I like to stay positive, but it's that wanting to create that. That's what the whole wanting to create that. Sorry.
If we were going to
Sorry,
rank
pet peeve.
these 7, the revenue growth, what I would put at the bottom. It doesn't tell enough, in my
not
opinion.
accurate.
Just looking at that.
Earnings growth. So earnings growth is basically, it's a lot like the 5-year dividend growth, where you can see over the last couple years, 5 years, 10 years, whatever, how has that grown up? How has that dividend earned or earned more every year? Earnings growth is the same thing. So are they like a roller coaster? 1 year's good, bad, next year's bad, or is it pretty consistent? And if there was a bad year in there, why? Don't get alarmed if you see something bad. Investigate it. Really. All right, next, free cash flow.
Man, this is
My
the
favorite.
This is the best one.
This is number uno.
That's it. So after you've paid everything, what do you have left?
Yep.
How much cash do you have sitting on the balance sheet after everything's been paid out? Because as you always say, this is where dividend safety becomes.
Yep.
This is where
Real metric.
like love that we can go and like this is something that companies report, and you can go look at that and then go look at what the outstanding shares are, what their dividend payment is, and how many years worth of cash does a company have on hand that they can consistently pay their dividend.
Preach it.
Let's go.
I love me some free cash flow.
And it's important that it's consistent, right? Because when you think of like a REIT or something like that, where all of a sudden that cash flow is huge and then all of a sudden a chunk of it disappears, I think it's important to pay attention to that over time as well. Because it can look really pretty, like we were saying earlier, in a season temporarily, and then all of a sudden you're like, whoa, where'd their cash go?
Well, you can look at a company and go, man, they could pay their dividend for 50 years and not make another dime. And then to your point, that same company 2 years later or 2 months later can only pay it for 25 because they just bought, some
they wouldn't bought
conglomerate property.
Right.
Yep,
Yeah.
absolutely.
All right, number 6, debt to equity ratio. Sounds pretty self-explanatory.
Yes.
It's like the flip side
But
of
this
that.
is this would be what I would call major red flags.
Right.
If this ratio gets too high, you can be in some serious trouble. But here again, it's almost like looking back at our payout ratio. Sometimes there's a reason why there's heavy debt and that ratio gets a little skewed. So just another kind of marker to dig deeper.
All right, a very interesting one here. Last one on the list. Return on equity. What do we got here? Anybody want to take a shot at this one? Like why would an investor really want to look on return on equity? This is more of a growth style metric. It's one we do look at, but this is an interesting one because it's really how good the company is at turning investor money or returning investor money back to them. So if I invest $100,000 or $10,000 into a stock, 100,000 across 10 stocks, and we're to rate them, the ROE, the return on equity, is like how much of my $10,000 am I getting back in dividend? What percentage am I getting? Am I growing? So of the money that's
It's
invested,
like the yield on your invested money.
yes, and that's why it's a little bit more of a growth metric than it is dividend.
Yeah, year
But it
over year
matters.
too, right? Not only that year, but ongoing.
I think you want to look at all of these
Yeah.
over time. Like the free cash flow to your REIT comment is really important in my opinion, looking back in time. Because if they have a really strong value, like right now, free cash flow, and they're sitting on $16 billion, some crazy number. Well, was it like 15 last year and 14 the year before?
Right.
Or did they just sell an asset?
Right.
And they went from 3 billion to 15 billion
Right.
and they're getting ready to deploy that.
Yep.
And it's going to go right back down to 2 billion.
Yep.
Because $2 billion, you might have a dividend that every time they pay a dividend on a quarter, it might be $500 million.
Yep.
It's like some crazy number. And you're like, oh, I didn't realize it was that much. Yeah. That's why you want to know outstanding shares. Right. So when a company buys back their shares and everybody all Washington goes all crazy about it, I'm like, why is that a bad thing? Because it strengthens the investor.
Correct. They're basically reducing their debt.
They're reducing their overhead.
Yep.
Like, I don't see that as a bad thing. Like, as an investor or as an owner, I want low debt. I want low responsibilities. I want more free cash flow because that makes everybody happy. All right. Last things, closing thoughts.
So none of these are kind of the end all be all. You got to kind of look at all 7. There's plenty other metrics that you can look at to evaluate stocks, but this is definitely a great starting point. So I'd say, kind of go through it, allow the alarms to be there, but use that as something to go dig deeper and really understand why.
And don't let these companies hide. Like, if you do your research, you'll be able to see the story. There may be something that might happen short term for something long term. And if you just looked at that snapshot, you might have missed a really good investment, and then vice versa. If you just look at the opposite side. So it's really look not just now, not just at one metric, look at it all together and make sure, it's healthy for now and in the future, especially if you're planning on to rely on that income.
Yeah. And I would just add, it's a great starting point, great checklist to start. What I didn't see on here was company logo or phrasing or shiny, pretty thing. So it's like,
or 52-week high.
Right.
That's right.
We also didn't really talk about yield. It's like, hey, check the business first, evaluate the balance sheet, and then let that lead you into yield and the income side of it. And that's almost like the last metric is like, okay, how's their yield? Like, what is the actual income going to be from this? But let's make sure we have a really great company before we ever worry about that.
And don't let your emotions get in on it, like the shiny things, but your emotions that you are that day when you see that shiny thing, because you might jump into something not right long term.
I would say create a score. I like to gamify things, especially when it is something that really matters. I feel like perspective, because of your emotions, can get out of whack really fast. And when you score things and the market turns upside down and you're like, hey, this is a 10 and 10's good, and things go upside down, it's still a 10. And you're like, well, should I sell? You own a 10.
Right. What else
What do you think you should do?
Yeah.
Right.
So when you put things into really good perspective and bad things happen and you rescore, it might help your emotional state. So hopefully you enjoyed this show. Just like Kyle said earlier, we do have a dividend starter kit. All you got to do is subscribe, put down in the comments that you want that. We'll send it right to you. Really easy.
Well, and if you have a question about a specific stock, just remember what we said earlier. That's hard for us to answer, but we want to answer it. Yeah. So give us the chance. If you got a specific stock, ask us. We'll do our best to let you know and be nice about your feelings.
Yeah. Depending on how well we know you.
Yeah.
All right. Bye.